What did I tell you, man? When YouTubers, when your favorite influencers out there are spewing that the market's about to collapse, run, I'm putting half my tendies in cash because I'm so scared. And then the market rallies is what always happens, which is a good reminder to buy when everyone's screaming fear, baby. And I want to get into the earnings because they were so damn pivotal. Man, this has been one of those exciting earnings periods I've seen in so damn long. So look at the tabs. Look at the tabs up here, baby. We got so much to get into on this rocket ship to financial independence. The damn all retire early. No one does it like we do it, baby. So hit that subscribe button, join the journey, folks, and hit a like while you're down there, because this rocket ship isn't like the one Boeing's been sending those astronauts to space on, where they've been stuck there for like 50 days. And I just wanted to point out Boeing before we get into the earnings. I find interesting because they suck, and they're finally replacing the CEO. I mean, their revenues were down 15%. We talked about the fact that the Starliner crew, was they're stuck up in that space station for they're supposed to be there for a week. It's now been 51 days, and it's all because of the Boeing, Starliner here, which is hilarious. So Boeing is actually replacing the CEO that got reamed out in Congress that we joked about with basically Ortberg, which is an aerospace veteran. So very interesting that this is finally coming full circle. They're stuck in space. The new CEO is a space vet. I don't know. It's just fascinating stuff. But let's get what matters here most, the juicy tendies that come out of these magnificent 7 companies. And we're going to talk about the 2 specific ones that posted this week that I like, which is Microsoft, which is Meta. Microsoft's heart fluttered a little bit. I think there is an AI overextended valuation in some of these stocks, right? And I think that's what we're seeing right now because the earnings were just phenomenal. You have the stock's heart fluttered a little bit and kind of just flatlined. And that's because I think the historical values for Microsoft's price to earnings is between 30 to 35 with forward PEs in the high 20s. But when we were getting up to 40, man, for a $3 trillion company, it's getting a little pricey. But I think we're just in a bit of a correctional period. Don't think we're heading into any material crash by any metric. This is not a bubble. This isn't the dot-com bubble here, folks. I think we're just overextended in quite a few companies, and there's some bubblish territory going on with some AI stocks in particular. But the reason that Microsoft went down, or so they say, is because their Azure cloud service came in and missed growth estimates by 1%. It's still growing at 29%, which is insane. But I do want to point out we are slowing down. And not in a material way that I think matters, so long as it's not like a new trend or something. But I mean, the revenue was only up by 15%. When I say only, I mean that incomparable to the last quarter, because the last 2 quarters, they were growing at 17%. And ever since coming out of the higher interest rate, really concerned environment where spending kind of locked up a bit, things have nominalized now. And I think we've kind of hit that nominalizational period where we're not really going to extend much higher for growth. That is just my opinion, but we're talking about a company generating $64 billion a quarter in revenue. To be growing at a double-digit clip is already mind-boggling enough. Like if you grew 1% on 100 billion, probably not complaining that much. But again, when you're trading at such a high multiple, you got to justify it. So we'll see what happens. We'll see what new quarters bring. But I'm going to applaud my fiance as she continues to hold Meta long and strong, baby. And you take a look at this, man. We're crushing it right now. I mean, Meta is back up 5% in after hours, trading back toward that $500 price point. And this is one of the only Magnificent 7 trading at a magnificent discount, in my opinion, because for an AI play to be trading in the higher 20 price to earnings multiple for the growth this company's having is very favorable. It's the most favorable company out there. 22% revenue growth, man. $39 billion. Their daily active people, for considering one third of all people, think about that. 1 in 3 people are using one of their apps, and it's still growing by 7%, the high single digits on a global scale. This company has not reached its peak yet. It is crushing 38% margins. Tesla friggin' wishes. Hell, even Apple wishes they could probably get up to 38% margins right now. This company is in a very great spot. But again, just like Microsoft, we're starting to see a stagnation going on here. We're talking about year over year 22% revenue growth rather than the 27 that we have been seeing since the recovery of the interest rate cycle. So just pointing that out there, but I still like these companies. And honestly, we are in a correctional period, but these are good buying opportunities because if this persists into the future, you get 1 or 2 more good years like this. I mean, whew, man, you're buying good valuations today, in my opinion, except for maybe some stretched, like Apple, I think is a bit stretched. Microsoft's a bit stretched. You could buy the Qs to play this. I'm not playing these as individually as much as I used to, but you kind of get the sense, right? So I want to switch a little bit because, Meta paying a 0.4% yield, Microsoft at a 0.72%. A lot of people probably looking at these yield-like stocks thinking they're so exciting. And I'm a total return guy, I tell you this. I like dividends, but I won't sacrifice dividends for total return. And that's what people have done with Altria Group, in my opinion. Altria is the definition of trash. Their management has failed at every corner of an acquisition, whether it's been Jewel, whether it's been the MJ markets. They pay a high yield. They bring in absolute morons, these dividend pumpers out there. And I know some of them are you. And I have exposure to this through SCHD, which I hate a lot. I don't know why they hold it. Because if you take a look, This is a U.S. oriented tobacco company. They don't sell internationally. They're purely exposed to the U.S., which is the worst tobacco market on the planet, which is seeing an accelerated decline in smokers. We're seeing a 13% decline year over year that is accelerating. So people eventually are going to see an inflection point in these stocks versus the revenue. You can only raise prices so much to make up for 13% revenue drops or 13% volume drops, right? So you have to be increasing prices dramatically, and they're not seeing non-smokable products increasing anywhere near fast enough to make up for that drop. Whereas I told you, if you want yield and you want tobacco sector like yields, go to British American. And I laughed and I couldn't stop gutting myself recently when I read the actual earnings report, because they've been crushing it this year and they deserve to be crushing it. Their earnings were pretty great, but I just want to point out one thing here. Their earnings were, good for tobacco giants, but the global tobacco industry volume is expected to be down 2%. So globally, people aren't smoking like they used to. However, what I found was hilarious is the continued weakness in US, France, and Sudan, offset by improving outlook in Turkey and Mexico. I was just in Turkey and people smoke like frigging chimneys. I think it's probably like the smoking capital of the world. You can't turn anywhere without a cigarette being blown in your face. So that's what I'm saying. If you want exposure to a growing new, non-combustible sector, vapors or whatever, British American Tobacco has it. If you want, non-huge amounts of declining in tobacco sales, they have it because they're globally exposed, and in other countries it's just more of a popular thing than it is in the Western world. Just putting that out there. So what does that say for consumer spending in the US when it comes, well, these are global companies, I guess, but we'll talk about them a little bit when it comes to just consumer products like Starbucks, like McDonald's. I do not like either of these stocks because they're becoming very expensive products. They used to be fast food. Starbucks never. Starbucks is overpriced coffee. They have no moat. They're in a very competitive market. I don't know why anybody wants to own coffee. It's just absolutely been abysmal for the last 5 years. Their revenues definitely show that. They've been down 2% year over year. They've been just squeezing margin to get their earnings per share up. So they definitely got their operating margins up and their operating income. But again, it's a sign of the times, right? When things squeeze, when things get tight and interest rates start making people pay more for their mortgage, their cars, you're going to see the higher valued products see a slower growth period. I mean, we've seen it with Apple, we've seen it with Tesla, and now we're seeing it with Starbucks and McDonald's. I mean, McDonald's just doesn't seem that appealing in this market environment when they're growing at 1% on a constant currency basis here to 6.5 billion. 1% growth rate is abysmal. If this keeps up at the way it's going here, guys, we're not going to see the kind of growth we've seen in the past. You just got to recognize that in markets like this, let the indexes kind of do the work for you. It's just kind of what we have to deal with here, right? So I kind of want to talk about this with Procter & Gamble as well, right? Because I'm somebody that was a true believer in Pepsi products, Procter & Gamble, like when it comes to toilet paper and toothpaste or Doritos even for that matter. You'd presume these are highly stable products. But the fact is when you start overpricing them and the consumer gets too strained, they will go for a no-name brand any day over a name brand product. And that's what we're kind of seeing here with Procter & Gamble as well. They're starting to stagnate on their price increases, right? I mean, their net sales grew by 0%. Organic sales, up 2%. Overall, this is just not great. EPS down 7%. Full year. There's just nothing crazy here. Nothing exciting about Procter & Gamble anymore like there used to be. These are kind of like your dinosaur stocks people would chase to get higher yields, and they really have to start proving why these products are sustainable and going to be reliable in the future. Because again, you've gotten a 38% return over 5 years plus, an extra 10-15% on the dividend. I mean, you're talking about what, a 40-50% return, give or take. Let's just say 50% to make it easy. But if we take a look at VOO over the same 5 years, you'd have seen a way higher return. So I'm just saying, like, the market conditions are really straining these traditional stocks, which makes it quite concerning. You look at companies that have absolutely been crushed. This is kind of comparable to things like 3M, right? When you take a look at Pfizer here, this thing fell off a cliff and is finally starting to get a bit of a revitalization. MasterCard, another one of these crazy, stocks that I thought would be growing at a much higher clip. Like, I'm honestly getting astounded constantly by like what I thought were foundational companies that are really traditional to society, but they're kind of reaching their peak periods, maybe not permanently. I mean, they could always find more growth, but they're just, they're trading at wicked high multiples and they're just not growing like they used to. Like their growth is just starting to slow down a little bit because they're probably reaching parity with the market. These companies, they can only grow so much, especially with MasterCard. It's a railway, it's a payment gateway. And the only thing that's going to disrupt this is probably crypto. And we're not there with that yet. But I mean, we're just not seeing the kind of returns that we've seen in the past, right? It's kind of just started to slow down a little bit. 5-year return, 72%. Still trailing the markets pretty dramatically. If you include the dividend, is way higher on the S&P 500. Now, these are obviously just my opinions. We also saw, the Jerome Powell came out today. If you didn't see that, kind of the same spiel. Data's great. We're going to wait a little bit longer. It's still likely we're going to get September Fed cuts. Here's a quick clip. You can take a listen.
We've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
So it's going to be neat to see if the interest rate cut cycle starts to recover a lot of these stocks. And it'll be really neat to see what it does for consumer spending in higher value products like cars, especially Apple. I'm so excited for Apple's earnings tomorrow, but I'll pass that question off to you. I'd love to know what you think in that comment section below.